Have you ever wondered how Canada is stacking up against the United States in the commercial real estate market? Well, recent reports suggest that Canada might just be pulling ahead. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to a new report highlighted by Wealth Professional, Canada is emerging as a stronger investment destination than the United States across key real estate and economic fundamentals. This report underscores Canada's resilience in the commercial real estate sector, with office vacancy rates in major Canadian cities remaining lower than in U.S. metropolitan areas, even after a significant development boom. Employers, particularly in finance and government sectors, are moving forward with return-to-office mandates, which is bolstering urban demand. The 2025 report from Colliers, titled Why Invest in Canada, emphasizes that while U.S. growth is bolstered by heavy deficit spending, Canada's federal debt-to-GDP ratio remains far lower, providing it with long-term flexibility. Adam Jacobs, the head of research at Colliers Canada, told Wealth Professional that the Canadian market is emerging from tough times. Although it's been a painful 5 years for the office market, the outlook is actually much worse in the U.S., even in leading markets like Seattle and San Francisco, he says. Development tends to be more and faster in the U.S. than Canada, which can lead to an overbuilt market, much less common here. Borrowing costs are also more favorable in Canada, with 10-year bond yields below 3.5%, compared to persistently higher U.S. levels. This historically low gap now exceeds 1 full percentage point. Adam Jacobs explains, real estate is more dependent on debt and borrowing than almost any other asset class. A 1% difference in interest rates is a huge difference and makes financing, refinancing, and development easier. The report highlights that while foreign investment in Canada has been slow this year, this can largely be attributed to the unprecedented trade war and tariff uncertainty. However, Canadian funds continue to be the second largest cross-border buyers globally, after the U.S., and ahead of larger countries such as Japan, India, and Germany. While interest rates are not the only factor, they certainly play a significant role. Canada's real estate market is not oversupplied like the U.S., where per capita office and retail space is far higher. Meanwhile, Canada's population surge, driven by record immigration, has fueled demand for housing, retail, and logistics space. Although immigration has recently cooled, forecasts expect Canada to regain a demographic edge by 2027. Retail has made a comeback after being out of favor pre-pandemic, notes Jacobs. The predicted takeover of e-commerce has not materialized in many areas, such as grocery, pharmacy, and alcohol, making retail a popular defensive investment during the trade war. In Canada, retail is less built out than in the U.S., so owners face less threat of competition or obsolete assets than in markets with more development. Canada's smaller, institutionally dominated investment market has proven to be less volatile than the U.S., avoiding the sharp downturn seen south of the border. Returns reflect this stability, with Canada seeing consistent gains in the MSCI Commercial Property Price Index, outperforming all G7 nations and several major global markets despite higher interest rates and inflation. In particular, Canada's industrial real estate, including warehouses, logistics, and fulfillment centers, has been one of the best performing in the world over the past half-decade. Rents have quadrupled in some markets, counterbalancing some weaknesses in other areas of commercial real estate. Interra Realty, a commercial real estate investment services firm based in Chicago, has successfully facilitated the sale of 2 vintage apartment buildings on Arlington Place in the Lincoln Park neighborhood, totaling over $13 million. These properties include 611-13 West Arlington Place, a 23-unit property that sold for $7.325 million, and 567-69 West Arlington Place, a 14-unit building that sold for $5.7 million. Interra Director Colin O'Malley represented the confidential seller of both properties, while Senior Managing Partner Joe Smazel and Director Mark Dykstra represented Hayes Properties, the buyer of 611-13 West Arlington. The buyer of 567-69 West Arlington was self-represented. This year has seen a surge in investor interest for multifamily assets in strong and resilient submarkets like Lincoln Park. Colin O'Malley noted, "These two properties underscore this trend, generating over 30 tours each, selling near to or above list price and closing quickly after hitting the market. Built in 1927, 611 to 613 West Arlington Place features 3 studio, 13 one-bedroom, and 7 two-bedroom units. On the other hand, 567 to 569 West Arlington Place, constructed in 1907, includes 10 two-bedroom, 3 three-bedroom, and 1 four-bedroom units. Many apartments in both buildings have undergone renovations in recent years, and both properties were fully occupied at the time of sale. These deals are part of a series of transactions executed by Interra Realty on Chicago's North Side over the past 6 months, totaling over $73 million. Notable transactions include the $10.7 million sale of 811 West Lil Avenue and the $16.1 million sale of a Rogers Park portfolio. The Arlington Place properties are strategically located, surrounded by Lincoln Park's numerous dining, shopping, and entertainment options, and are within walking distance of DePaul University, the Lincoln Park Zoo, and Diversey Harbor. They are well served by multiple bus routes and the Chicago Transit Authority's red, brown, and purple lines via the Fullerton station. Sandy MacKay, in a significant move to bolster the multifamily housing market, Countryside Farms is set to add over 120 multifamily units in De Soto. This development is part of a 75-acre project south of Kansas Highway 10, which is gradually taking shape in the area. According to the Kansas City Business Journal, the plans include both apartments and duplexes, marking a multi-phase project aimed at addressing the growing housing demand in the region. Sandy MacKay. The project is strategically located near major developments, such as a planned data center campus and Panasonic's substantial $4 billion plant. These nearby developments are expected to drive demand for housing, making this project a timely addition to the community. With De Soto's backing, the mixed housing project is set to receive a boost, further enhancing the local real estate landscape. Sandy MacKay. It's exciting to see such developments taking place, especially when they are so well aligned with the needs of the community. The addition of multifamily units not only provides more housing options, but also supports the local economy by attracting residents who will contribute to the area's growth. This kind of strategic development is exactly what we like to see in the multifamily real estate sector. Sandy MacKay. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.